This week was dominated by growth concerns in China, rapidly falling crude prices, currency volatility and nervous global equity markets. What do all of these portend for the global economy? In this special interview, Senthil Chengalvarayan and I spoke with Eswar Prasad, Senior Professor at Cornell University and Senior Fellow at Brookings. Now, Professor Prasad is one of the world's leading economists and has also headed the IMF's China division. So we began by asking him about the slowdown in China's economy, the spate of weak data from China, and the Chinese government's recent clampdown on the use of certain high-yield debt as collateral for some kinds of loans.
The Chinese government is trying to strike this very fine balance where they want to maintain growth momentum even as it is slowing, continue with their financial market and broader financial sector reforms, and at the same time not go back to the playbook they had back in 2008-2009 during the financial crisis when they had this explosion of credit which helped support economic growth but is having very negative ramifications to this day. So the move taken by the Chinese government today sort of indicates the tensions that they face. What they're trying to do is let the air out of the housing bubble very slowly, try to make sure that there isn't too much fraud in financial markets, while at the same time trying to make sure that there is enough credit to support economic activity. But they don't want to do it with this broad-based expansion of credit, but do it with very targeted instruments. And this is a very tricky balancing act. And today, what they've been trying to do clearly is set off tremors, both in China and in the rest of the world. But it's going to be a hard slog for China, just dealing with what they've come in with since the last 5 years.
So, Eswar, you spoke about both the financial market and the real estate market. They're both areas of challenge for China. Do you think they'll be able to come out of this successfully?
I've always been amazed at how the Chinese have managed to get through this difficult balancing act. But right now it's a very fraught issue because there is a huge amount of credit outstanding in the economy, and although credit growth has slowed, it's still growing at about 2 to 3 percentage points above nominal GDP growth, which is about 9 to 10%, and credit is growing at about 13%. So in some sense, the problem is still growing. Now, what they've tried to do, rather than increase credit expansion significantly, is to use very targeted measures that try to direct credit to parts of the economy that can generate more employment growth in particular. But that means that they have to go back to the old ways of working, which is telling banks how much to lend and who to lend it to. They've been trying very hard to get away from this, but it's not been very easy to manage. The housing market is much better under control than it was even a few months ago. They managed to let some air out of it. In the first-tier and second-tier cities, the very large cities, it's less of an imbalance right now. But the third-tier cities, the smaller ones, where there is a lot of overcapacity in the housing sector, that is the real concern, because now there is a lot of excess capacity and they're trying to manage the decline in prices, but at the same time there is a lack of affordable housing in those very cities. So it's a conundrum that they've not been able to solve very effectively yet.
Professor Prasad, you know, the Chinese government set its GDP target for this year, that's 2014 at 7.5%. Many people believe that they will make it to 7.5% by the end of the year tally. The expectation is that the growth target for next year will be a lower one at 7%. Now, you know, depending on how much faith you put in the data coming out of China, what does that 7% really mean? Not just for China, but more importantly, for a global economy that's suffering, you know, potential recession in the Eurozone, Japan still sort of trying to get its act together. What will 7% growth for China mean?
Now, China has been the biggest contributor to global growth since the financial crisis, because the U.S. economy is certainly picking up a lot of momentum right now, but the Chinese economy, despite a bit of a loss in momentum recently, is still a very fast grower, and China has become very important in many markets around the world, especially when you look at commodities. China drives commodity demand at the margin around the world. What is important is not whether China will get to the 7 or 7.5% next year. I'm almost certain they will, because they have a lot of space in terms of monetary and fiscal policies. The big question is, how do they get there? If they get there as a part of the process of rebalancing the economy so that it's more consumption driven, it's going to be better for China and for the world in the long run. If they do it through, again, a burst of investment that is fueled by credit expansion, that's not good for China, and that's not going to be good for the world in the long run. In the short run, actually, it may provide some degree of support to commodity demand, which is very important to many emerging markets, but also some small advanced economies like Canada and Australia, which export a lot of commodities. But ultimately, this will mean a lot more excess capacity in China, and the only way they can grow out of that is by exporting all this excess capacity. And there are already concerns that China may be exporting deflation to the rest of the world. And given that many countries in the world, especially Europe and Japan, are already facing deflationary pressures, it's certainly not helpful. So how China gets to this number of 7%, I think, is going to be the real crucial question in the year ahead.
Okay. Yeah, you've sort of given us a couple of cases or scenarios with regards to commodities. I'm going to ask you a few more questions about that, broadly speaking, and then specifically to crude. Many people believe we are at the bottom of a commodity down cycle. Where would you put us in terms of a commodity down cycle across the world? Of course, given what China is up to, but otherwise as well.
Well, it's largely demand-driven at this stage because there doesn't seem to be that much of a change in the supply. To take a commodity like oil, it's clear that OPEC is not going to be able to get together and cut supply a lot. We've had the shale gas revolution, especially in the U.S., affecting supply in the U.S., but also certain other countries like the U.K. So it's really a demand-driven phenomenon right now. And in terms of demand, right now, what we see as we look around the world is patches of weakness practically everywhere except for the U.S., which seems to be having an increasingly strong recovery. China, where there is a bit of a loss of growth momentum, but it's still a fast-growing economy. And India, where there is some potential upside. But other than that, most of the other emerging markets like Brazil, Russia, South Africa are in fairly dire straits. Europe and Japan are facing a very dangerous deflationary environment. So if you look for strength around the world, other than the US and China and to some extent India, it's hard to see much of the sign of strength. So I suspect we're going to see continued softness in commodity markets for some time to come.
What is the negative impact of continuing softness in crude oil prices, especially, sir?
Again, this depends on the country we're talking about. For a number of countries around the world, especially those in the Middle East and quite a few other countries that are oil exporters, it's going to be very difficult in terms of managing both fiscal balances and current account balances. India, I think, is one of the countries that it's going to benefit in a variety of dimensions because it benefits our fiscal balance, it benefits the current account balance, it's going to help with the inflation. So it's very hard to see any negatives for India. In the U.S., for instance, it's a very mixed bag. In the U.S., of course, the fact that you now have oil prices declining makes shale gas a little less competitive. But on net, it's a bit of a plus for the U.S. because it does leave a lot more purchasing power in the hands of consumers, which means that the U.S. is still going to have strong consumption demand. But around the world, this is, I think, a sign of economic softness. So in that sense, oil prices are falling, which is a good thing in many senses. But why it's falling is certainly not a good harbinger of what lies ahead for the world economic recovery.
So, Ishwar, we are cheering in India at $65 a barrel. At what point should we start getting concerned?
Well, India is not that dependent on foreign demand. So I guess for India right now, if oil goes to 65 or even slightly lower, it's not a big negative. But it does imply that there is going to be a lot of weakness in external demand. And countries in Latin America, like Venezuela, which already have a very difficult situation, emerging markets like Russia, and of course the Middle Eastern countries, plus some of the European economies like the UK and Norway, that rely on oil exports to a significant extent, are going to be facing fairly difficult situations. This will affect their budgets and their current account balances, which in turn will affect their consumption demand. So a softness in consumption demand is ultimately not good for anybody in the world, including India. So I think there is a point at which falling oil prices are not going to be a net plus even for India. I don't think we're quite there yet, but we're pretty close.
Okay, before we talk to you in a little bit more detail about India, Professor Prasad, can you talk us through what your assessment is of the current trouble in the Eurozone as well as in Japan? How badly off are both these regions, and are they likely to be able to get their act together in the next year or so? Maybe Japan, yes, but the Eurozone?
It's going to be a very difficult and challenging time for both of these economic areas. In Japan, Prime Minister Abe did seem to be ready to unleash his three arrows, which is monetary policy, fiscal policy, as well as structural reforms to get the labor and product markets working much more efficiently. But Japan faces this much deeper background problem of very unfavorable demographics with a declining population and a declining labor force, and that's going to be very difficult to deal with. But I think the reality that Japan faces right now is that they're still relying on monetary policy, which is the Bank of Japan essentially printing more money, buying more assets. But this is going to have very limited traction in an economy where the supply side is not working very well. So ultimately, unless Japan can undertake some of these structural reforms, such as getting more women in the labor force, freeing up competition in certain product markets, it's going to be difficult for Japan to fight the deflationary trap. Europe faces a similar situation right now, and I think this is sort of endemic of many advanced economies around the world, this excessive reliance on central banks in order to do all the heavy lifting in terms of supporting growth. In the Eurozone, there has been a lot of progress, even in the periphery countries, in terms of freeing up labor and product markets. There has been progress in terms of bank restructuring and in terms of moving forward in banking union. But the reality that Europe again faces is that debt burdens, public debt burdens in particular, are still very high. The financial system is not generating much credit. Business and consumer confidence is at very low levels. So ultimately, you're going to need a combination of all three policies: fiscal stimulus, monetary stimulus, and structural reforms working together in order to lift Europe out of its deflationary trap. And right now, the reality again is that it's monetary policy that's doing most of the hard work, and that's not a good recipe for long-term growth.